Go.
Ready?
Mm-hmm.
Hey, what's up, guys? This is Carlos Handal with Handaling Real Estate. This is our third episode. We'll be talking now about loans, loan program. I got Caitlyn here. Caitlyn, do you want to tell them?
What's up, guys? It's Caitlyn Marcell. I'm with American Financial Network. I'm a loan officer and branch manager here in Greenville, South Carolina. Just offering as much education to home buyers as possible from the moment that they come into Carlos's hands all the way through closing, and then Carlos always goes above and beyond.
So tell me a little bit. So clients obviously, at least usually come to me first, right? First question, most of them, not everyone, but most of them are nervous. They don't want to get their credit pulled, or they think their credit's bad, or they think they need a 720 credit score to buy. So first thing I do is I say, okay, we need to talk to the lender. Like let's start step by step, right?
Yeah.
So here's Caitlyn. Caitlyn, tell them what they need. Like how do you go about it?
So first I always ask with what we call like a pre-qualifying phone call. It's, hey, where do you think your credit is? Clients always say, oh, I've got a 720, I've got this, I've got that. Okay, based on what? What app are you using?
Okay.
Credit Karma, Mint, CreditWise, all of these apps. And then it's like, all right, let's talk about myths with credit.
Okay.
Credit Karma, CreditWise, all of these apps, they're just third-party marketing apps. They're not truly your credit bureau.
So that's not the score you go by when buying a house?
Never. And you have to have your credit pulled every time. Everybody always asks, do you have to pull my credit?
Now here's the thing, like most people are afraid of their credit, because it takes a hit. Is it a soft pull, a hard, how would that affect their home buying process?
So it's really, this is the rule of thumb that I tell people. It's, your credit's not going to be impacted if you're just applying for mortgage loans within a 90-day period, because the credit report goes back and it looks at the last 90 days of inquiries. So if when I pull your credit, it's going to show that you've applied at the, Target for the red card, Victoria's Secret, Cabela's, it's going to show me all these inquiries. And then you apply for a mortgage, it looks a little spontaneous to the algorithm, and then the algorithm's going to go, whoa, 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 and it's going to decrease based on inquiry. But if they're just applying for mortgages, the credit bureaus recognize that's good debt. They want you applying for mortgages. So apply for mortgages when you know that you're ready. Start applying. Put in the application, then you know.
Okay. And I mean, we have to apply because otherwise we don't know how much we qualify for, right? Or how and so what about, let's say, best case scenario, everything looks great, we move on, and we're going to talk a little bit about the programs later maybe, but let's say you still need to work a little bit on, your credit's not where it needs to be, what would the next step be there to help them?
It's always a game plan for breaking down what debts they have, how many times they've been late, and it's really just making sure they understand. On-time payments, that's everything when it comes to credit. One day you are going to be just buying everything and all of your cash. I know you will. I'm going to ask you for money one day. I know it. But right now we need good credit scores until there. Yeah, so people have to make on-time payments. That's number one. You got to make on-time payments. And then number two, it's the debt to income ratio. So making sure that your monthly debts are low. You can have an $80,000 car, I don't care. If your monthly payment is $1,700, that's a problem. If your monthly payment is $300, we can work with that.
It's okay.
Yeah.
Okay. And you can tell them, hey, based on your credit here, maybe depending on how much money you have in the bank, maybe we can bring pay this credit card down, or maybe it's not beneficial to pay it. You can guide them and all.
Everything. People always ask, should I pay off all my credit cards to zero? And everybody is different. So me and you could go and say we both have 720 credit scores. We both have $30,000 in the bank. We're gonna buy a single family home. But your credit report and my credit report are gonna be different. You started credit. Maybe you started getting credit before I did, or maybe I have other credits that maybe they're in deferment and how they're reporting on the credit. Everybody is so unique. It's kind of like a fingerprint with that credit report.
So that's why it's important to
Every
pull your
time.
credit and move forward with it. And so how much credit do I need to buy a house? Do I need a 700 plus credit score to buy a house?
You can buy with a 500 credit score, but you better have a ton of money in the bank. Like seriously,
Okay.
people come to me all the time and they're like, I've worked with a VP of a very large company, and when he first started, he had an 810, and then he kind of wanted to make a few plays. He came back to me like 4 months later. I refreshed his credit report. He had a 520 credit score. I was
Ooh.
like, hey man,
That's a big difference.
I said, what's going on? He was like, oh, don't worry about it. I'm going to get my attorney involved, and it's misreporting. And then within 30 days, I refreshed his credit report, and he was good to go. Like it was
Okay.
back to an 810. But for the people who have 500 credit scores up to really 579, you've got to have money in the bank. I mean, more money, less problems. Even when it comes to lending, there's nothing that's cut and dry. You can get outside of the box with non-QM or non-traditional lending, but
It's going to cost you a lot of money.
it's going to cost you some money. So the
Okay.
better the credit score, really 640 plus, that's where things start to become
Okay.
easier.
Okay, so 640 is kind of.
That's the target.
Okay.
Yeah.
Okay. And how much money do I need? So you're talking about, we need to have money. So do we need 20% down payment? Do we need?
No.
Because whenever you pull in Zillow, that it always
Mhm.
tells you, it calculates at 20%. So
Every time.
everyone gets scared when they see
Yeah.
that.
There are programs that are out there that are $0 down,
Okay.
like true $0 down. USDA and VA, those are true no money out
Okay.
of pocket down payment loans. And then you have loans that grant you down payment assistance, or they'll second lien or second loan you the down payment funds. Those are risky. I mean,
They're higher rate probably.
higher rate, higher mortgage insurance, there's always going to be something. The thing about lending is it is for profit. Like
Yes.
nobody's working
Yeah, the
for
bank's
free.
gonna make money.
The bank's gonna make money one way or another. It's all about being educated and knowing how it plays.
Okay. So it all depends on what program
Mm-hmm.
they go with and
Every
what
time.
program they qualify for.
Every time.
What about closing costs?
Closing costs are constantly a conversation in the lending world about what is a true closing cost.
Okay.
So there are origination fees, processing fees, underwriting fees, states.
Attorneys.
Attorney fees, like South Carolina specifically is an attorney state. You have to close right now with an attorney, and they have fees. So understanding also the escrow for homeowners insurance and taxes. I like to tell people, before you have the conversation with anyone, whatever that target price is that you want to be at, get 3% of that sales price.
3%. Okay.
3%, like $200,000, your target, that's $7,000. If you've got that and you've got a 640 credit score, somebody can make something happen for you.
Okay. And we can always, depending on the market conditions, we can always negotiate closing costs. I mean, that's my job.
Yeah.
And lately I've been seeing it more than, the past couple of years, of course.
Yeah.
Sometimes we can get the seller to pay them, but it's not a given. So it's a good idea to always have some money saved in the bank then.
And please be super clear with everybody. I mean, I've worked some, I don't want to say miracles, I'm not Jesus, but like, I've worked some things where like, they came to me with $150 in the bank, and
Okay.
they had great credit, or they could get a gift, or they had a 401k, or they had they were doing a USDA loan or VA loan with $0, and then the seller paid all of their closing costs. Like, there are unique scenarios, but again, it's like that fingerprint.
Okay.
Everybody's unique.
So like you said, everyone's different, and that's why it's important to talk to you first and
Every time.
get that ball rolling, like get your credit pooled and
Yeah.
see where we're at then.
It also helps you
Okay.
with expectations, because, I mean, when people come to you and they're not pre-approved and they want to see a $400,000, $500,000 house, what's the first thing you think?
Well, can they afford it?
Exactly. Are you approved? Like,
Yeah,
do
you
you have
pre-approved,
money?
can you afford the payment and
Mm-hmm.
down payment and everything? Yeah.
So it's really expectations. I think that's the biggest
Okay.
thing we can't control if someone's not approved or doesn't just have cash.
Yes. Okay. So, rates. Do you make up the rates? Like who controls the rates? So and especially now it's a big thing because we went from high rates to extremely low rates, and
Yeah.
some people, we all got spoiled of the low rates. know if we're ever gonna see that again, but like, how does that work? Like, how do, like, is it based on credit score or?
Yes,
Like,
it's based on
okay.
everything. So things that impact rates, you know, we have to keep in mind that neither of us can control the rate. That's not something controlled on a local level. What is controlled on a local level, and broker to broker, loan officer to lender, whatever, it's the rate sheet that's coming out. So like if you were to apply today for a mortgage loan, your rate sheet in today's market would be anywhere, it would have a 4.875 on it, all the way up to a 7.875. It's gonna increment up and down by about an eighth.
Okay.
So that's your rate sheet. My rate sheet would be similar, but maybe our credit score, the type of property that we're buying, you know, if it's a fourplex or if it's, you know, a single family
That's gonna
condo,
affect those.
all that stuff
Okay.
impacts your rate sheet, and really determining where you want to be, that's your decision. And people
Yeah.
ask all the time, well, do you think it's a good time to lock in the rate? Man, if I had a crystal ball, I would make way more money doing something else, not this. This
Not
is too
this,
stressful.
yeah. That's true. And so how, again, we don't know where, you know, your rate is gonna land, but if I have a little extra money in the bank, and I hear all the time clients say, well, the lender told me I can, you know, buy down the rate, buy discount points. How, I'm assuming that's on a case to case basis also, right? Like
More money, less problems. You can do anything if you've got the money to do it. It really comes down to if it makes financial sense. The question that I ask on the lending side is, how long do you plan on being in the home? What's that break-even point financially based on the upfront investment to get that lower rate? And like me, I've moved 10 times in 8 years. Getting a 30-year fixed rate mortgage and buying down interest rates for me isn't the same that it would be for you. How long have you been in your home?
this one, just a year. I don't stay in the houses more than,
Yeah.
like one of our homes we stayed for probably 2 years the longest, then
Yeah.
usually a year, sometimes even less. Like
Yeah.
I move a lot.
You did new construction?
This last one, yes.
Tell me about new construction. What's the process for new construction? Like if I were a home buyer and I see a home that was built in 1990, which is a very young home, just to be very clear,
Mhm.
that's like super young. Compared to a home that is new construction built. Like what is the process? Do I have to wait? Do I have to pay all the money up front? What does that look like with you? Because you do a lot of new construction.
Yes, so I would say that the biggest difference is with new construction, yes. If it's an inventory home, if it's they call them spec, like a house that's already built or under construction, it can be the same as a resale home, like 45-day closing, whatever. They do, since we're talking about the loans, like new builders, unfortunately, push you a lot to work with their lender. I guess whatever our regulations, I'm not allowed to talk too much about it, but they will push you and they will tell you that their preferred lender will give them closing cost or other benefits, versus a resale home where you're on your own basically. So if you're talking about the loan side, I can always negotiate those closing costs still with the seller, so it would still be, and I always say when it comes to the lender, talk to different lenders. Like it's, most people don't get married to the first person they ever date, right? Like you gotta talk to different lenders, see who works better for you, what can they offer you. In terms of the house itself, so I would say the reason I love new construction is because it has all the warranties. It's a different process versus, I know you're renovating a house right now, your house, and
it's
right?
brutal. Oh, it's
Yes.
brutal.
We've renovated a couple houses, and one of them when we were living in it, the other one before we moved in, and it can, it's always more expensive than what you're thinking it will be, and a lot of headache and work, but at the same time, the house might have more character than the brand new house. So there's pros and cons, and maybe we'll have an episode like this, we'll talk on another one all about that.
Yeah.
But in terms of the loan process, yes, they usually have their preferred lenders. They'll, offer you to go with them. I always say, talk to them, and then talk to the lender you're working with already and see Sometimes they'll offer you, some of them are pretty clean. They'll offer you the closing cost, and it is actually true closing cost and
Yeah.
nothing hidden. Others, they'll move that money into the loan somehow, and you're still going to be paying for it one way or another. So,
Right.
so that's where you come in. That's
Yeah, and again, it's not, lenders are not one size fits all by any means. Again, in every applicant is like a fingerprint. It's super unique. The scenario, the timeline. So some new construction lenders will lock in an interest rate for 180 days without additional fees. You could look at the loan estimate, and then you can look at a loan estimate with someone who's not the in-house or preferred lender, and really just compare apples to apples. But I tell people all the time, don't compare a quote to a loan estimate, because
they're very different.
super different.
And that's another. So now let's start. Let's say the build process lasts 6 months, right? Which is, if you start building, that's usually. So first thing I get asked all the time is like, well, what is my rate going to be what would your answer be?
Oh, for the new construction client, it's when do you want to lock? Because the longer the lock period, the longer the fee, or the bigger the fee, I should say. So like, it's inexpensive to a lender and less risky for a lender for a 30-day lock. It's not a big fee, if any fee at all, for a 30-day lock. We're just guaranteeing that you are going to have this rate as long as you close in this timeline, really short timeline. This is where the market's at. But in 2021, I mean, at the beginning of 2021, I was quoting rates in January at like 2.75, and then in December at 7.25.
Yeah, it was a roller coaster. I remember that.
It was tough. And then like clients who were in new construction who wanted to play the market, or it's kind of like Russian roulette. If you don't lock when you're comfortable with the monthly payment, it could be higher, it could be lower.
You don't know what's going to happen.
Yeah.
And that is the thing about the longer bills. So we don't know what's going to happen, and no lender can tell you.
Right.
When are you going to, if you look 60 days, we don't know what's going to be, and rate's going to be in 4 months from now, right? Like
right.
So what's the difference of we know USDA, so that's a zero down payment. VA, that's veterans. I guess you have to have been active military.
You have to be eligible. Just because you've been in the military doesn't mean you're eligible. So we need a DD-214, you need your COE, certificate of eligibility. Like you have to have VA benefits. Some people get into the military and they quickly get out for whatever reason.
So then they don't qualify.
And then they don't qualify. Yeah. So VA eligible buyers know if they have a DD-214 or a COE.
Yeah, I have no idea what that is.
No, it's fine. But again, you're not military. You shouldn't.
Exactly.
But most of the time, I tell people the same thing. When it comes to just asking loan questions, and I'll say, "Do you have yada yada yada?" And they'll say, "I don't know what that is." I'm like, "Then it's not you."
It's not you.
Yeah. So VA. The great benefits about VA buyers is $0 down, and it's you're not paying mortgage insurance monthly, which is something that you have to take into consideration.
So what is the mortgage insurance?
So mortgage insurance is really a lender protecting themselves, and you're paying kind of like car insurance. Like I've never been in a car accident, but I still pay car insurance because if anything ever happens, I want to be covered and protected and safe and taken care of and not have this huge bill. Same thing with mortgage insurance. If you're not putting 20% down, skin in the game, then the lender is lending a ton of money.
Yes.
They want to be protected, so they're taking a tiny little piece of kind of insurance to protect themselves every single month until you've met that skin in the game threshold, that 20% of the value.
So that's different than your home insurance, right? That's
totally different than home insurance. Really common question. Homeowners insurance compared to mortgage insurance. Mortgage insurance protects the lender. Homeowners insurance protects the homeowner. Yeah. So like, what do we have here in the upstate? We don't really have tornadoes.
No. We don't really have hurricanes either here.
Not really hurricanes. There are flood zones, but I mean, still, like homeowners insurance, broken windows. I've had 2 broken windows because of a lawnmower just whacking a rock at the window. But I mean, like that's covered and it gets paid. It's $500 fix, but I'm contributing to that. Hail damage on the roof, stuff like that. And again, working with someone who's responsive, who's got good coverage. Like, this is very much a you get what you pay for with homeowners insurance. I've learned
Yes.
it, I've worked with many different
That's
providers,
right.
and
That's
it's just
right.
a whole nother thing to consider.
That's right. And so how much is the mortgage insurance then? Is that the same as PMI?
Same
When
exact
people hear
thing,
PMI all
yes.
the time.
Exact same. So PMI, prepaid mortgage insurance, mortgage insurance can be divvied out into the monthly payment or upfront. It can be split to where at closing you
Okay.
pay a large chunk up front and then a small amount each month until you pay it down again to that 20% of the value that you've lent on. So it's kind of just this.
So they need to talk to you about
They
that.
need to talk to me
Yes.
about that. Again,
Okay.
it's unique
Okay.
every time.
Okay, I know, I sell houses, so I'm gonna explain our relationship here, because people always ask me, said, well, I get people calling me first, and then I
Yeah.
said, well, we gotta talk to a lender, to a loan officer, and they said, well, what's the difference? I thought you could help me. I said, Caitlyn's gonna give you the money and I'm gonna spend it for you.
That's it. You
That's
get the
what
fun
it is,
job.
so yeah, exactly.
That's
yeah,
what I
so-
tell people all the time. I'm like, Carlos gets the fun job. He gets to dream with you about the backyard and talk to landscapers
Yes,
about
that's
what we're
right.
gonna do, and the contractors, oh, you can knock out this wall, and
That's
oh,
right.
new countertops would make this look perfect. I have to sit behind a desk all day with my
Make
big,
sure how to make it work.
yeah, I'm like
Yeah.
calculating everything, dreaming in numbers. And he's like, oh, new
That's-
furniture in here would totally change this place.
That's
I'm
right.
telling you.
That's
So
right,
yeah,
that's
you
right,
were
that's
great
right.
at spending the money. I'm just
Exactly, that's how it is. And, okay, so USDA,
mhm.
real quick, just like what
USDA.
makes it eligible? What?
It's based on location. USDA, it has to be rural, and that
Okay.
doesn't mean cows and farmland. It's really based on population.
Okay.
So it has to be in a rural location, and you look this up when you look
Yes.
for homes.
Yes,
like,
I can help them look
Yeah.
it up, and we're looking at it, like I can tell them if it is or not
yeah,
USDA eligible.
and then they're just coming to me, and it's very unique if they qualify for USDA because it's household income. So
Okay.
like if you and Marissa and maybe your daughter all have jobs, well then if you're above the household income limit, then you don't qualify
Then
for
you
USDA.
qualify,
Yeah,
okay.
compared to a single person purchasing a home and there's only one person, or even one person in a household of 5 but it's only one income.
One income, okay.
Then we're looking at that income based on how many heads are in the household. So USDA is very specific to that,
Okay.
as well as it's much more stringent
Yes.
on how much debt you can have. Again, that debt to income ratio is
Okay.
lower for
So
USDA.
they need to talk to you again to figure
Every
it out,
time.
unique
That's it.
situation.
Yeah.
So, before we run out of time, so the other two, the loans I see the most are conventional and FHA, but
Yeah.
I think more FHA than conventional.
Mm-hmm.
So what's the difference between those two, and does it affect first-time home buyers or not? Like what's,
There are very few loans that are only for first-time home buyers.
Okay.
FHA is marketed as a first-time home buyer loan, but it's not only for first-time home buyers. FHA requires only 3.5% down
Okay.
compared to some conventional products go at 3% down, but you've
it can
mostly
go up?
it can go, yeah, typically it's 5% down for conventional, but the best route to go is the lower mortgage insurance that you can get, the lowest down payment that you can get. Like everything plays into your specific scenario, as well as where's your credit score,
Okay.
you know, that
So-
makes a big impact.
So first-time home buyers, because again, like most first-time home buyers ask me all the time, like, hey, like I'm a first-time home buyer. It's like my dad or my friend, they told me that to ask you about it because there's benefits to first-time home buyers. Do they really get a big benefit? Like what's
If they've got good credit, they do. If they
Okay.
have bad credit, they don't make payments on time, they don't have a history of savings, then they're not gonna reap the benefit of any
Okay.
of the true first-time home buyer programs.
okay? And maybe we can talk in another episode more in depth about this, like our first-time home buyer programs and all that kind of stuff. What about your investors? Like, okay, so I already own a house and I want to buy another one now, but I don't want to sell this house. Like, I want to keep it. I want to start investing. I want to start my portfolio. So, how does that work? Like, how do I qualify for the other one? Do I need to rent this one? Do I like?
So many different scenarios. So
Okay.
there are DSCR loans that are based only on the rental cash flow of the property that you're buying.
And I hear a lot about those recently. I've actually
They're
closed
fantastic.
a couple of them.
You got 20-25% down on a 1 or 2 unit property or up to a 4 unit property. then you can buy a DSCR loan with just based on cash flow on the property, and it's a great way to start the
So
portfolio.
that's perfect for investors then. That's
Perfect. If,
okay.
again, more money, less problems, then you can just work on the cash flow of that property. You're looking at maybe a second home. Maybe you guys want to buy a home down in Hilton Head.
Yeah.
Well, that's just a second home. It's 10% down. You'll look at the structure with interest rates. They're slightly different for second homes or, you know, multi-unit homes,
Okay.
condos. Everything is impacted by the type of property as well as where the property is and what it's going to be used for.
Okay, and how many properties can I buy?
As many as you want.
Okay, okay, especially with the DC, what is it called?
DSCR.
DSCR loan. And are they gonna, so, you know, I'm a realtor, so I'm
Mhm.
basically self-employed, 1099.
Yeah.
I know when you're on a W-2, it's a lot on a salary, it's a lot easier to buy, get paid hourly. For us, it's a little, you're probably the same as me, I don't know, but, or maybe you're W-2, I don't know, but how does it work with, do you go straight off my income or do you go by my taxes if I'm using the
I'm gonna
DCA?
go off of your, well, DSCR loans are going, you can go based off of just the cash flow of the home. And then there are other programs that are just bank statement loans. They're
Okay.
like cash flow loans. But a lot of self-employed borrowers, I have to tell them, like, when you're getting ready to file your taxes, if you made $150,000, don't write off $150,000.
Yeah, you still gotta pay taxes, you gotta.
Exactly, be strategic. Like, we need to look at everything, especially now that it's tax season. I'm telling people, call me, bring in, conference in your CPA or your accountant, whoever. Let's game plan for the future of this year and what you want to make happen.
Okay, okay. So, alright, well, we're running out of time, but I think this was
I thought it
pretty
was great.
useful. And I think maybe we can have another, you know, next time talk a little bit more in depth about all these programs and
Yeah.
maybe a whole investor episode, or again, first time home buyers is the biggest one because of course I'm sure it's the same when they come to you, they're nervous, right? Like they're scared and you know, they've heard that if they get their credit pulled, it's gonna drop, and then how am I gonna buy the house and all those kind of things. But that's what we're here for. Like that's what I'm here for. That's what Caitlyn's here for. We're here to help. And if you don't know the answer, just call us and we'll work it out and we'll find the best way, right?
Always. If there's a way, we'll get it done.
Yeah. So we'll talk to you guys in another episode. This is again Carlos Handal, Handaling Real Estate, and
Caitlyn Marcell.
so thank you for listening. Thank you for viewing if you're on YouTube or Instagram, and we'll see you guys soon on the next episode. Thank you, Caitlyn.
You're welcome. Bye, guys.
Awesome. I thought that was awesome, actually. I thought that was pretty good.
Now, if you guys don't end up posting that,
Oh, it
Just-
will get posted.
just tell me. Just
Oh,
say,
it will get
"Caitlyn,
posted. So now,
This is the problem.
literally it's
Tell me.
processing right now, right?
Okay.
Oh shit, let me stop this one. Well, these ones are easy to edit, the videos, but so let's see.